What's up, guys? Eric here. What's going on with the stock market and what can happen next? If you're watching this video, I'm actually out of the office on vacation for a couple days, and I made this video just in preparation. There's CPI data coming out, and if you're watching this video, you already have that data. So depending on that data, if CPI, if inflation was hot, the market's probably selling off some more. If that was light, you might see some buying. But I want to look at history here because generally speaking, September is a pretty weak month for the stock market. And if you look at the history of the QQQ, we have two other bear markets that we should compare to see what happened before. And it doesn't mean it has to happen again a third time, but I think the data is quite interesting. And I'm not showing this to you to try to spread fear, uncertainty, or doubt, or make you worried or scared or anything like that. If you watch the video and listen to what I'm saying and watch the entire video, you'll have a good perspective of what I'm trying to teach here. So this is a chart of the Nasdaq 100, the QQQ. All right, so we're going to look at this and see what happened the last two bear markets. So I'm going to go to a 2-year chart and let's just look at this a little bit more closely. All right, so this right here, this is the top back here in November of 2021. We got to about $404 a share on the QQQ. Now that is the high, that's the top, and that's what we need to basically take over if we want to go higher and really establish ourselves in a new bull market. Now, most will tell you that we are in a bull market. You could also, depending on how this plays out, it could be just a huge bear market rally, but it would be the longest bear market rally in history. And you can see what happened though is we basically fell off a cliff from 404 down in 2022. We got to 260 and then a sharp bounce up here, topped out around $383, $384, now at 370. So we are 5% basically from those highs in that range. And let's see what can happen because we are coming into a weaker month. We've got lots of macro uncertainty. We've got that CPI data. There's other things, people are worried about recession, interest rates being high, how that's putting pressure on the market longer term, those ramifications. You look at consumer spending, 70% of GDP is people spending money. If they have less disposable income because interest rates are higher, mortgages are higher, rent's higher, you've got student loans coming into play, what could happen longer term? And again, I'm not doing this video to try to scare you or spread FUD. I'm just showing you what happened in the past, some history, and I think it's good for you to be aware. Because I'm not going to be a channel that comes on and tells you just buy no matter what. The skies are blue, rainbows and unicorns. I'm also not going to make those videos where the market's going to crash, 50%, sell everything. I'm not going to do that either way. I'm very bullish long term. I'm a long-term investor. I'm always buying. If the market goes lower, I buy more, and I'm looking 5 years out every time I'm buying a stock. All right. So that's what's going on right now. So remember this. 404, dip down, pop up, it's starting to dip. The question is, where do we go next? Now let's look first at, we'll look at 2008 to 2011. So I'm going to go back here to 2008 and 2011 and hit apply. Now what's interesting here, if I go back to these dates and I zoom in on this chart. So here you have this run up going into 2007, right? You have a sell-off. So imagine this being 2021. This is that top. This is the bottom at 2022. This is the rip at 2023. Now, we've gotten a little bit higher in 2023, but we haven't taken out that previous high. We got up here, we dipped, and then we tried to pop up, we dipped, and we fell off a cliff. Now, what's interesting is you look at the dates here. This is basically going to be September. So this is August right here of 2008. You had some volatility. It's not exactly the same, but you had this high, you failed, you sold off, you tried to run up again, you failed, and you fell off a cliff. And of course, there's lots of macro events that tie into this. This is not in a vacuum or anything, but it fell off this cliff. So November of 2008, we're way down here, and it took us some time to get back. And if you look at this, 2008, this is May of 2008, it took quite a while. It took about 2 years to get back to that point, and then more resistance, and then finally 2010. So this is going, 2 full years. We then, take out that peak there, and then to take out that previous high, it goes here, 2011. So that took from basically 2007, October 2007, all the way to, February of 2011. So you're going 2-3 years in that time frame, and you have a big valley in the middle. Now let's look at the dot-com bubble. Let's look at 1999 1999 to 2002 and see what we come up with here. So pull this up. We got another run going into the late 1990s. So again, picture this being 2021. Picture this being 2022. Rip up. This is kind of where we're at now. Sell off, rip up again. Look at the date. Exactly the same. August 28th, 2000. So historically, it's been a bad month here going to September. This fell off a cliff, and then it traded sideways for quite a long time. Now, you see these stats all the time, like, if you bought this QQQ back in 2000, it took you 16 years to get, if you look at this, it goes all the way to 2016 over here. It took you 16 years to make your money back, but nobody's just like buying everything on one day and not buying again. If you were buying in 2000, you probably had a small account, you're buying a little bit, and you're buying 2001, 2002, you're buying all these years accumulating. And if you're buying and holding, you've got a lot of money in that time frame. And this is why long-term investing works, because the trend is going to be up with time, but it's not just going to be up every day, no matter what. There's going to be peaks and valleys. And if you're buying the whole time, you're thinking long-term, you have the right mindset, there's obviously better times to buy than others, but you look perspective here. Yeah, it sucked if you bought here and you bought, instead of you bought here and it dropped down to here. But if you would have bought any of these prices, look at where we're at now. You say, well, that's a long time. It's 20 years. Well, I mean, most investors are investing for 10, 15, 20 years. A lot of people right now, because of the pandemic, you have this get rich quick kind of mentality, like, oh, I made some money on this or crypto or meme stocks or whatever. That's not a normal market. That's not a normal market. And it's not something that's just going to, keep happening all the time. But the message here, I really just wanted to teach you the history of the charts and show you what the possibilities are. It doesn't mean it has to happen. It really, if you're buying a stock right now, if you're buying today, just know that it can always go lower. And, you would love to just buy a stock and have it go green every single day from the time you buy it, but that's just not how it works. And if you think that that's how it has to work, you're probably not going to be a successful investor, because you're going to, chase FOMO, you're going to buy high and you're going to sell low. So FOMO, fear of missing out, buying stuff when it's all going up, 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 up. Everybody was chasing, NVIDIA when it was $475. Now all of a sudden, boom, $430 a day and so on. And then you have full fear of losing everything. So you buy high, then stocks start selling off. And then you sell the lows because you're afraid it's just going to go to zero, right? Fear of losing everything or full. So the message here is just have that mindset, that discipline, try to have the correct time horizon. Now, if you don't have 10 and 15 years, you should be investing a certain way that fits to your risk tolerance, your suitability, your needs, all those different things. But if you have that long-term horizon, you're buying all the time. You're still working. You're getting paid every paycheck. You're buying stocks. You're trying to get the best prices you can, but you're not going to be perfect. You're not going to time the bottom. You're going to be wrong on some stocks. In the end, you're still going to be successful. You're going to make money. You're going to achieve financial freedom. And it's as simple as that. Long-term investing is the simplest way to create wealth ever invented. And it's really not that hard. The hard part is the psychology behind it. Knowing that you buy something today and it could go lower, and how it eats you up like, oh, I should have done this and I could have done that. No, coulda, shoulda, woulda. And just think about the long-term horizon. If you buy Tesla at 245 and it goes to 190, it'd be great if you just perfectly bought it at 190 and it went green every day. But if you get it at 190, 200, $250, if that ends up being a $2,000 stock, you're happy either way. Now, I'm not just saying that you can just buy any stock at any price. And I'm also not saying that it's not important to get the best cost basis. I'm just saying that you're not going to be perfect every time. And if you're picking the right stocks, that's the most important. If you buy a stock that is up, 2 months from now, but you're holding it long term and you've got a 50% gain and don't lock in those gains and it goes out of business, well, you didn't make anything. And this is why it's so important to monitor your stocks. Make sure it's nothing is ever just buy and hold forever. It's buy, hold, and monitor. If that story changes, you cut your losses. If you're down, move on. Peter Lynch was right 6 out of 10 times, and he said that was a favorable result, and he still crushed the market, did it 10 years consecutively at the Magellan Fund. If you haven't read One Up on Wall Street, I think it's the best investing book of all time. Go check that out. But I'm telling you guys, this is a tough market. We do have a lot of macro risks. I think that I'm optimistic, but I also understand there are a lot of macro risks. There are a lot of geopolitical risks. We could still have a recession, and the market could certainly go lower, and we're going into a seasonally weak period. and the market ripped from January, and people are taking profits, and there's really just any excuse to sell. Earnings are done. 80% or so of the S&P 500 have beat expectations, but expectations were low. Well, now the market has nothing except CPI. So we're selling off here before CPI. CPI comes in light. Maybe the rally keeps continuing, but understand even if it does that, there's risk because valuations are high. If you look at historical valuation, and the risks are piling up as well. The Fed is going to have to cut rates, and they're going to have to start reducing rates, and that could create a catalyst where that bull market keeps going. But the longer they don't do that and disposable income deteriorates and people put more money on credit card, there are going to be push-pull dynamics and ramifications to that. And you need to understand that as an investor. And it doesn't mean you should try to time the market or be afraid to invest, but just know if you buy any stock that these things could happen in the whole market. If the whole market sells off 10%, your growth stocks are going to be down a lot more than 10%, and understand that risk. With reward, there's risk. Your portfolio is up 50, 60% this year. Well, you're taking risk with that, and there's also a lot of downside risk as well. You've got alpha and beta, and make sure you build that portfolio that fits that risk tolerance, the needs, the suitability, the DNA of you. I hope this video is helpful, guys. Make sure you subscribe to the channel, click that bell for notifications, drop me a like, drop me a comment. Have a great rest of your day. Take care.